This is Create the Next from ProCFO Partners, where every week we explore strategies and ideas for financial management and growth to help today's businesses put their financial picture in context.
Welcome back to Create the Next. I'm Chris Bentliff, and I'm joined today by Shyam Desigan. And Sam is a managing partner for ProCFO Partners. And Sam, it's great to have you on the show. It's great to be able to have this opportunity to kind of explore your mindset and your expertise around software as a service. The acronym is SaaS, everybody, capital S with two A's in the middle. And software as a service is something that a lot of us use without necessarily knowing that that's what it's called. But on the flip side of that, those of us that are engaged with running, founding, managing SaaS companies have an awful lot to think about. It's kind of the new dynamic for a lot of digital sort of business. And we're even seeing some of its principles, subscription-based, for instance, spreading outside of that. It's a fascinating space. Let's start with a little bit of why is this an area of interest or of passion or of concern for you? And what is your kind of your overall perspective of the SaaS environment as it's been, emerging a little bit new in the last 5 years, but almost a stable mainstay now?
Yeah, thank you, Chris, and thanks for inviting me. I've been in the software and SaaS space for close to 15 years now. Started with co-founding two companies in the space and selling them, and then went on to be a CFO for others. So, like I said, it's really taken off to a point where pretty much all the software in most companies is being acquired through the SaaS, from a SaaS perspective. So it's not, as other than fairly large companies, most of them are leveraging, subscriptions, whether it's Amazon, whether it's Salesforce, whether it's yada, yada, right? Mm-hmm. But the question is, as a SaaS company, there's been a lot of venture capital that has poured into the space, and companies have gone to a great degree to only focus on growth. So customer acquisition has been at any cost, right? And now the situation is, companies have got to watch their bottom line as to what they're spending to make sure their customer acquisition costs are in line with lifetime value of the customer they acquire. So, so from that perspective, it's becoming super critical for SaaS companies to finally get to a point saying, okay, we got to be profitable. We can't just be showing growth and expect venture capital to pour in, because those days have gone. So now it's a time where a lot of companies in the SaaS space are looking at fiscal discipline, looking at, what is the customer acquisition cost, what is the, what is the lifetime value of the customer, and what is the revenue churn rate. So some of these SaaS metrics are super critical, because they may not get the next stage of funding without being able to prove that they can be a profitable business. I'm going to take a pause, Chris, to see what are your thoughts on some of my opening comments.
It's fascinating. And I love that you're sharing some of these kind of key perspectives: lifetime value, cost per acquisition, churn. These are important key performance indicators, KPIs, of kind of how we're running our business. And I think there's a lot of kind of satellites orbiting those big principles. For instance, if you're running a trial, how many of those people are turning into customers? How many of those people are engaging past the first day and into the 7 days of the trial, or whatever? There's a lot of different metrics that can be kind of leading indicators into what's going to happen. And I'm wondering what your thoughts on that are. What should I really be focusing on? You mentioned the three big ones. Is that, if I get those down, am I okay? Or should I be thinking about some of these ancillary things that can also be shedding a lot of light on the health and potential of my operation?
Those three things are critical, because lifetime value, right? Historically, it's been okay. You come up with a basic math, but people have not, or companies are not really looked at the cross-sell cycle, upsell cycle. What is the portfolio of products? What is the product line expansion? So, putting a number on a presentation to the VC is one thing, but really think deeper into each of this is important, right? Even customer acquisition cost, maybe it's channels are getting important. I mean, maybe you can be part of a Salesforce ecosystem, Amazon ecosystem, Microsoft ecosystem, and try to leverage the ecosystem to build your customer base, right? So from that perspective, I think what is important is not the number of metrics. What is important is how deep have we spent time in understanding those metrics and be able to flush that out with our advisors, whether it's investors, whether it's, even large customers, key customers. So that's the different perspective that we like to highlight.
Are you finding that again and again and again, those three or one of those three is being ignored or not given enough attention to? Like, I'm wondering if I could give one piece of advice to every SaaS operation out there, it would be this first simple thing to get started with, simple in our terminology. But what is kind of the chronic issue that you're seeing?
Yeah, I think the chronic issue is a lot of times I'm seeing companies where they really are not able to demonstrate that the lifetime value is more than like 2 or 3 times what they've spent on the customer acquisition, right? So whether it is, and that determines how they're able to determine, because large companies that have been in the SaaS space for a long time, they've really mastered that and they've pushed the LTV to north of 5 or 6 or 7 times customer acquisition cost. Whereas if you see then some of the younger companies, at least till this year, who are flush with venture capital funding, and even Zoom, for example, right? 70% of Zoom's costs are marketing costs. Now think about it, right? I mean, I really don't know how they're going to survive when there's a Google Meetup option, which is free, right? So how do you survive? How do you fight free? So I think companies are forced to think about that, and no wonder, all of a sudden now you see all these layoffs because people are realizing that the customer acquisition costs, which also is quasi sales and marketing, now has to fit the equation in terms of what is your lifetime value, whether you're getting 6 or 7 times and not, spending $1 for every dollar of lifetime value. That equation is being questioned. So LTV to CAC is something which is super important now. And a lot of, companies are now looking at it pretty seriously as if we can bump that number to beyond 6 or 7, where it really makes it optimal. And I can give you one example, and Chris, you'll find it fascinating. I was listening to a company, one of the founders of a unicorn called Freshdesk. Freshdesk is based out of India. They have like 2,000 sales people, but they are valued at $10 billion. And from their perspective, they have automated everything around customer acquisition, right? Everything has been automated. So it's light human touch, more automation, to a point where it is built into a number of channels. So their customer acquisition cost is extremely low. Another example is like ChargeBee, which has really baked their solution with good channel partners. So today, I think that's another critical thing where now you want to partner with channel partners to be able to acquire customers without going and spending the money. So that's just a snapshot of different ways in which we advise companies and we help them make it become more profitable from a customer acquisition.
I love kind of what you're sharing around this idea of, I don't know, some realities are coming up, or we're hitting some truths. And you mentioned layoffs. Is the mood of venture capitalists changing? Is the mood of investors changing? There was a time where it was like, oh, that's a good idea. Let me throw some money at you. And now they're kind of wise to a lot of that happening too. The pandemic, anything that had to do with remote, anything was, just through the roof, stratospheric growth. You mentioned Zoom, and now that's coming back to earth. What are you finding out there that is driving some of these needs to really have a better sense of your LTV, lifetime value, and CAC, which is customer acquisition costs? What's driving on the other side, on the investor side?
I think definitely from an investor standpoint, their LPs who have been investing in these funds are really tightening the belt. So all of a sudden you have SoftBank, you have Tiger, you have all these big names that have had bleeding, right? That have the last year has been terrible for them. So when they are not able to show the returns, some of the LPs that are investing in these funds are saying, oh, you know what, we need to really tighten our belts too. So the cash flow into those venture capital funds are drying up. And from that perspective, now, at least I know a lot of the venture capital funds are now going to the portfolio companies and saying, hey guys, be ready to tighten your belts for 2 years. You have to use your cash and don't come back to me for a check, right? so now all of a sudden there's an existential crisis for some of those companies that have to totally revamp themselves to be able to survive. So I think it's a good thing. I'm a turnaround guy, so I always like to see belt tightening, and I think it's good. It's a good time from that perspective.
If I have to put my energy into something to kind of straighten this out, and there's no one answer. Everybody's different. Every organization is different. But should I be working more on product features to attract new customers? Should I be spending more on marketing to try to get more customers? What's kind of the sweet spot for how I should be approaching this so that how should I be nurturing or cultivating my existing customers to do more and more with that lifetime value? What are some advice or points that you have for us there?
That's a great question, Chris. I think the key issue is to make the product as friction-free as possible, right? From a user adoption perspective, if you lower the amount of friction, then you see the adoption skyrocketing, right? So I think that's the most important thing. A lot of it comes down to the product itself. So if you're able to make the product friction-free, make the adoption friction-free, make the training friction-free, then you see a user growth without really going crazy, because a lot of the SaaS companies have customers that are probably not using it across the organization. For example, there might be one division of a large company using Tableau, but guess what? There might be other 5 divisions or 5 departments that are not using Tableau, right? Within the same company. So now you have access to the customer, except now you just got to build it out, right? So that's another way to do it, where now you make it so friction-free and you increase expand the envelope of the footprint of the product, that now it can touch into other departments. And that's another way to do it. So yeah, I don't really think purely ramping up on marketing is the way to go. I think it's really about smart spending, and that should be a balance between product side and marketing side.
Good advice. What if I'm listening and I'm a founder, or I'm a executive, or I'm a decision maker in this space, and I'm stressed out because all the things you're saying are really hitting me. What should I be expecting from my CFO? Do I have a CFO? Have I been just sort of offloading this to some guys who are smart in the operation that, have a financial mind, because we're a lean team of founders? What should I be doing from that perspective, where some key insights, some expert insights, some advice and guidance could really help me?
Yeah, I think the key issue is if you don't need to necessarily have a full-time CFO, but at the very least, you need to have, fractional folks like our company who are advising them at least periodically. So directionally, they are not going in the wrong direction, right? And I think most of the venture-backed companies have a CFO or a director of finance, and they should be asking these questions, because the free money is gone. Now it's time to you have to sweat for getting the next check from the investors, right? So the CFOs are going to be under a lot of pressure to ask the tough questions and make sure that the company is not going overboard on spending and is able to drive the revenue without commensurate spend on the marketing.
Sam, it's a really clear point. Either get the guidance, or if you have a CFO or director of finance, make sure that they're asking some of these tough questions. I like your advice about tightening the belt, and I love this focus on these 3 KPIs, which is lifetime value, customer acquisition cost, and or churn rate. And if we can start to figure those things out, we're building a more attractive company, a more attractive product.
Awesome. Yes, indeed. It was a fantastic call, Chris. Appreciate it. And you asked some great questions. I'm excited. I think it's a good opportunity to advise the companies in the SaaS space.
Well, as our chief executive officer Nelson Tepfer always seems to say, call us. The first thing you should do is call us. So we're leaving you with that kind of space. Shyam Desigan, has been so nice to meet you. So nice to have this conversation. Can't wait to have you back and continue learning about your insights and your expert advice and your generosity in this space with us. Thanks for being with us today.
Thank you, Chris.
Thanks for watching, and a special thanks to our subscribers. Consider becoming one today. Visit ProCFOPartners.com for more strategies and ideas for financial management and growth to help you put your business's financial picture in context.